Welcome to Banrion Capital Management's What's the Alternative podcast. Join host Shana Orczyk Sissel, the queen of alternatives and founder, CEO of Banrion Capital Management, as she interviews leaders in the alternative investment space. Learn more about their firms, their passions, and about the many different ways investors can use alternative investments to add value in their investment portfolios. Hello, everyone. My name is Shana Orczyk Sissel, and I am the founder and CEO of Banrion Capital Management. And this is What's the Alternative? Today, we have with us the founder and managing director of LYNK Capital, Ben Lyons. Ben is a prolific real estate investor. Over his 37-year career, he has learned a ton about real estate and investing as a financial advisor, investor, and business owner. He grew up in Baltimore, Maryland, and by the age of 25, he owned 100 rental properties and had $1 million lending business. Now that has grown, but one of the things he loves the most is teaching folks about real estate investing. And since real estate is such a area of interest for a lot of investors right now, and I know our financial advisors are getting asked about it, it seemed like a very good time to have Ben on the show. So welcome to the show, Ben.
Well, thanks for having me. I'm excited to be here.
Thank you. LYNK has recently joined Banrion's platform and has some really interesting opportunities for advisors. But I think the best way to kind of help people understand LYNK and LYNK's offerings is to understand where you come from and how you started your endeavors into real estate investing.
Yeah, absolutely. Well, first of all, LYNK is an 11-year-old firm. We're structured as a Reg D 506C offering. And we say we're in the real estate business, but we're specifically in the real estate debt. So senior secured debt, meaning first mortgages only on predominantly residential housing. So that's single and multifamily housing. We are in what's considered the transitional space, which means that we don't make long-term loans. The loans that we provide are specific to real estate investors and real estate builders, developers, mostly for the transition of the properties. So example, they buy a foreclosure, renovate it, and then sell it, or they are building it. Once the property is built, if it's multifamily, the borrower will get permanent financing. And if it's a single family home, it may also get permanent long-term financing, for which we don't do those loans, only as an accommodation. But I've been doing this now, it's 40 years. August 21st, 1983 is when I started. That's the exact date. And I got very lucky. I went to work for a father-son. The father was retiring. The father had been in the real estate business for 40 years. And they had lent, they'd been a private lender. The father was a private lender and also bought a lot of real estate. So for 40 years now, I have been enjoying the benefits of real estate, both on the debt and equity side.
So can you talk a little bit about how you first endeavored into real estate? Was it purchasing properties as sort of like a rental properties where you served as landlord, and how did that kind of grow and build? And really, what piqued your passion for real estate?
Well, truth be told, the summer I graduated high school, I met a PhD in exercise physiology who no longer was in the exercise field. He said, well, Ben, if you want to be financially successful, you really don't want to go into exercise, which is what I was thinking I was going to go into. So he said, get into real estate. And a neighbor of mine happened to have been in the real estate business, and knocked on her door, borrowed some books. She happened to tell another neighbor who was the father and the son, and they invited me to come work for them for free. So I graciously took a job at age 18 working for a father-son, very successful father-son in the real estate space. And they agreed to teach me if I went to work for them for free. But I knew it the first day. I knew it by noon that day. What was fascinating to me was that you could buy a property, and I talk a lot about in my courses the use of leverage. When I first started buying real estate, so I bought my first rental property for myself at age 19. and I borrowed money from a wealthy attorney at 2% a month. So I was paying the low cost of 2% a month, but I ended up using this gentleman's money, and I bought over 100 rental properties by age 25. And these were all single family, relatively low end rental properties in Baltimore. I would use somebody else's money, buy a property, stick a tenant in there, renovate it. I did a lot of renovations myself at night. And, the ability to leverage other people's money, if you think about most people buying real estate, they are using bank financing, which is leverage. So they're buying an asset that is typically 5 times, in most cases, as high as 20 times the amount of capital that they actually put in. So I was very drawn to real estate for the wealth creation benefits. So I'll pause there.
So you said 2% a month, but we're talking like mid to early to mid 80s. So what were the prevailing interest rates for mortgages at that time? Because I think
right.
everybody who's listening is like, wow, that seems insane. And it probably was higher than market rate, but it's also probably not that insane considering where rates were at that time.
That's right. 30-year mortgage rates for the average home buyer when I started in 1983 was 12%. So when rates hit 9.99% for the 30-year home buyer, everybody thought that they were giving money away, which is fascinating today. If you think about getting 30-year mortgage rates at 9.99%, everybody would say that the world is coming to an end. That's
They
why
think the world's coming to end right now, and mortgage rates are at like 6.5, 7.
That's right. Well, it's relative to affordability.
Right.
What's the percentage of someone's income relative to the mortgage payments? And so affordability isn't great right now, just because, as we know, low interest rates pushed asset prices up.
And now no one wants to sell, and that adds to this problem. So yeah, that definitely is a different landscape in that time than it is today, for sure. Maybe that's a good time to kind of transition into, how real estate as an investment has evolved since you started in the business all those years, like 40 years ago. Because what kind of ups and downs have you seen, and sort of how has the way you approach real estate evolved over time?
Yeah, I like to explain that real estate really comes in several different forms. And as an investor, and since your listeners and watchers are really investors, you can invest in real estate equity, or you can invest in real estate debt. If you think about it fundamentally, the approaches are not the same. Real estate debt has been historically dominated by the financial institutions, the banks, the credit unions, and you don't really think about individuals investing in real estate debt. I used to go around the country asking people that were high net worth individuals, how many of you have a checking and savings account? And everybody would raise their hand and say, of course I do. Then I would ask, well, how many of you know the top 2 lines of income at most banks in this country? And the answer is real estate secured interest income and fees. I'd say, well, let me ask you this. How many of you in this room have mortgage interest in your retirement or non-retirement accounts? In other words, you're the lender secured by a property, so you collect mortgage interest. How many hands do you think would go up in a room of 100? How many people have mortgage interest?
Maybe 2.
That's right. It was typically 5% or less. In some cases, it was 0. All right, so let me get this straight. You all hand your money to a bank in a checking and savings where they pay you very little, and the bank takes your money on a 10-to-1 leverage ratio, because the banks in this country are leveraged an average of about 9-to-1, and they lend it out to somebody else secure and collect interest, but yet none of you do that as an investment. So for me, talking about real estate debt as an investment strategy is really my passion, because I learned at age 18 from a wealthy father-son that regularly would provide mortgages to people as an investment strategy. But yet, historically, most people just don't do that. So investing in the property as an owner and collecting rent, or investing in the property in debt and collecting mortgage interest, still investing in real estate, just 2 different strategies.
Similar cash flows, correct? I mean,
similar cash flows, sure.
Go ahead. I was going to say, which do you think is kind of more stable, and what are the pros and cons of each?
Yeah, so with a mortgage loan,
Mhm.
it's income, it's taxable income, right? It's interest income.
Yep.
You don't have the benefit of appreciation, depreciation, and amortization.
Mhm.
So the reason we come in as a real estate investor is that we get the benefits of tax, right? We get the depreciation of tax benefit. We get the appreciation, the fact that as an owner of an asset, the real estate values historically go up, so you get the benefit of that.
Mhm.
You also get the benefit of amortization. If you use debt to finance a property, your tenant is basically increasing your net worth on the investment, then you get the benefit of cash flow. So owning real estate or coming into the real estate equity side gives you actually four attributes. Whereas if you come in on the debt side, you only really get one. You get the contract between you, the borrower, and you, which is really just income.
Mhm.
A little bit different. The way I explain it in my courses that I teach is if you're coming in as a real estate lender, so on the debt side,
Mhm.
and you are not leveraging that strategy, meaning you're only using your own cash, you're going to get between 8 and 12% return. If you're coming in on the equity side, which is what most REITs or most real estate plays are, most real estate plays typically target 15 to 25% all in return. So it's
Mhm.
a very different investment strategy. So it's really just a matter of which strategy you want. I like to tell people come in on both sides, both debt and equity, but they serve two different purposes. The last thing I'll say is that mortgage debt acts very similar to fixed income.
Mhm.
You really need to think about if you're going to deploy money in mortgage debt. So you've got a secured investment. Your money is secured by the property. So it's somewhat protected. You've got a contract with the borrower, so it acts more like a fixed income contract. So it's a little bit more consistent and a little bit more predictable. I really think that mortgages are a fixed income investment on steroids. That's how I explain it.
So I also have to imagine that if you are, an investor who's thinking about like, do I want to do mortgage debt or do I want to purchase properties? All of the benefits you talked about, that's great. But the one thing you didn't touch on, which I think kind of is important not to gloss over, is when you own a property and you're serving as the landlord and you have tenants, there's also, you have to manage the property and you have to deal with those relationships, which,
That's right.
may be worth the hassle for the extra amount of potential return that you get, but it is still a job and work, and there's, whether you do it yourself or you outsource it to a management company, there can be potential stress involved in that, just the nature of the beast.
Yes, great point. And what I explained is that the reason you're only getting, let's say, an 8 to 10% return on debt, you're targeting double that on equity, is for that exact reason. It doesn't come with it doesn't come without a price. And the
Right.
price you pay coming into equity is the fact that you have to collect the rent, you have potential vacancies, you have also potential um, valuation declines in real estate. Um, so it comes with a lot more risk.
Mhm.
On real estate debt, you know, if you've got a property worth 500,000 and you lend somebody 300,000, you've got 200,000 of protection there.
Mhm.
And if the worst thing that happens is the borrower doesn't pay and you have to foreclose, well, you end up with a $500,000 asset for 300,
Right.
which is you end up on the real estate equity side anyway, but you end up there at a discount.
Yeah. So there's pros and cons to everything, and your returns or potential returns are reflective of the potential risk that comes with it. And I always think that's important for people to consider. There's no free lunch and with any of this, so those are important considerations. So let's talk a little bit about real estate broadly speaking. I mean, I know that you're more focused on the residential side, but real estate is pretty vast. And I think a lot of our audience, I once helped launch a residential real estate REIT house with Armada ETFs. And we always used to talk about everybody understands real estate and the idea that everybody needs a place to live. But the actual landscape of real estate is broader than that. There's a lot of different types of real estate. I know you're more in the residential market, but can you speak at all about how there's just different areas and pockets of opportunity in real estate. And right
Absolutely.
now, some of them may be more attractive than others.
Yeah, and as a form of background, I used to own. I was a founder of a commercial bank, community bank, Maryland Permanent Bank and Trust, and we did nothing but commercial real estate. And today, I'm developing self-storage offices, wedding venues. All of my career has not just been in residential. I love residential, but commercial serves their purpose. When I talk about real estate equity, what I like to say is that owning income producing real estate is nothing more than renting time and space.
Mhm.
And depending on whether it's self-storage where you're renting little tin boxes, or whether it's hospitality, you're renting rooms for the night, or whether it is a golf course or a wedding venue where we're renting an event space
Mhm.
for an event. Real estate, nightly rentals in the residential side, real estate is always about renting time and space. How much time and how much space really depends on each individual investor's appetite for whether they want to own industrial, do they want to own office, do they want to own hospitality, do they want to own single purpose, Walgreens or fast food restaurants or whatever. So I just think at the end of the day, it's really what's attractive, what's producing the best returns, what's got the highest risk, and what's going to give you the great opportunity to maximize time and space.
So there are two areas I hear often are sort of the areas where their supply demand dynamics are really off. And that's residential, which I think we talk about all the time, but also healthcare. And this idea that, senior living and nursing care type facilities are inadequate for the boomers. And then in the residential side, we all know that the dynamics there are also a little off. So where are you seeing the best opportunities? Is it those two places? Or there somewhere else that you mentioned self-storage? I hear about self-storage a lot. I know a lot of people that invest in that space because they like its predictable cash flows, very low management costs because it's a tin box, as you put it, and there's stuff in it. And if somebody doesn't pay you, then the stuff is yours. And there's not like, heat or tenants you have to deal with in that respect. But where do you think there are the most interesting opportunities in today's market?
Yeah, that's a good question. Not sure I'm really qualified to answer broadly. I think we all know about the vacancies with office not being a great place. I'm always partial to where the demand is there, and demand still exists in housing. So multifamily, I would say entry level multifamily is workforce housing, tremendous population of people that still need to occupy that area. I personally like wedding venues. The reason I like wedding and event venues, the premium you get on a per square foot basis for a weekend, one night, you can rent a space for a very high premium just because it's a one night event that is pretty cool.
People
So
will gladly spend ridiculous amounts of money on.
that's
Yes.
right. Yeah, I mean, if you think about a property where you can lease it out 3 times a month, 3 days a month, right? 3 out of 30 days a month, and make, 200 coverage, it's a great business. It's a specialty business. So I think is great. Obviously logistics for a while was really hot. But I don't know that I know all the sectors to give great advice in this area. Multifamily housing, I think, has really been great for the last 5, 6, 7 years. I think you're seeing an oversupply potentially coming in the next 3 to 5 years because everybody got into that space, but there still seems to be a shortage of housing.
That's really interesting. My younger brother has been looking, and my ex-husband, for that matter, have been looking for residential housing rentals for months now, and just having all kinds of trouble. In the case of my brother, affordability is an issue. He lives in Massachusetts, which I recently learned is the most expensive state in the entire country to live as a family, which shocked me. I was completely unprepared. I believe it's for a family of four to live comfortably in Massachusetts, you have to have an annual income of over $300,000, which is
Yeah,
bonkers.
that's
And
four and a half times the national average.
yeah, that's bonkers. I figured it would be California or New York, but no, it's Massachusetts. And then in the case of here in Chicago, if the rentals are few and far between, and they go quick, real quick, and they end up in weird bidding wars, which is such an odd thing to be in a bidding war for an apartment, where it goes on the market at a certain rent, but there's so much interest in it that the rent gets pushed up just by people saying, no, I'll just pay you extra, or I'll pay you 6 months in advance. And the entire concept is crazy to me. Are you seeing similar trends in other areas of the country? And I haven't heard anybody say anything about potential for oversupply of multifamily. Is that nationwide, or are there specific pockets where people should be cautious because there's overdevelopment going on?
Yeah, and I'm one of these guys that I'll give you the negative side of something just because I like to talk about risk and risk management. It's just my personality.
I'm the same, so I get it.
I think when you look today, I think the demand absolutely way outweighs supply. So we're talking about today, it's fine, and maybe even tomorrow, it's fine. What I look at is the pendulum always swings. You know, the Fed pushed rates way down through the Treasury threw money into the system, and all of a sudden, you've got just asset prices ballooning. And then to correct that, they jacked up rates in an unprecedented way. And that's going to have an effect. But what happened with housing is we have this huge demand for housing. Money's cheap. Everybody's going to build. And then it's going to cause an oversupply at some point. Now, today, the data suggests there's not an oversupply. And I agree that there is still a great demand. There was pent-up demand because of lack of supply, and household formations continue to outpace the construction. But I think my forecast is that three years down the road, we're going to potentially see an oversupply of housing. It's my own opinion. Just because of what happens, everybody jumps in, and when I look at the permitting data, acquisition of assets and properties going through pre-development, I see 3, 4, 5 years out where there potentially could be an oversupply, dropping this demand that we see today. Just my own view.
Interesting. You did mention earlier that you do both multifamily and single family. I think since the pandemic, we've seen rising demand for single family rentals. Is that an area that you're seeing development? And how does that work? Because that's a relatively new trend, correct?
Yeah, I mean, you've seen 3 or 4 of the very large private equity firms of the last 5 years gobble up. In fact, the largest buyer of single-family homes, foreclosure homes, and distressed homes, and in the last 5 years have been institutional investors, not individuals. So the reason for that is that rents have gone up much faster than the costs, and demand is been very strong. I think you're seeing, because of home prices, that is slowing down dramatically. But traditionally, mom and pop were the buyers. You know, individuals were the buyers of single family investment homes. But I've been buying single family homes for rentals for 40 straight years. I enjoy it. You can get more efficiencies when you buy a multifamily. You can get more efficiencies buying other assets than single family homes. But you've got a huge population of buyers and renters in that home price between 150 and say 500. You have an enormous population of buyers and renters. So it's for that
I
reason.
just want 150. Where can you buy a house for $150,000?
Yeah, I know. It's well, in a lot of urban areas. I'm from Baltimore, and I could buy in 20 zip codes here regularly at 150, believe it or not.
Oh,
Still.
wow.
Yeah. Yeah.
Interesting. Are these areas that most people would want to live, or are these places where there's additional risks associated with them?
Well, we're talking about as an investor from an investor's point of view, where the population of renters and buyers. So as a buyer, I'm looking for a premium in rent.
Uh-huh.
And in these areas of 150 to 200,000, there's a tremendous population of renters,
Okay.
and that drives premium of rent. Uh, Typically I tell investors that once you start getting 250 and below, the lower you go from 250,000. I know it's, in Miami and San Francisco and in Boston, 250 is a garage, right? You can barely even buy a garage.
Right.
So it's hard to believe that in most of America, the median home price is $400,000. So,
Yeah.
it's actually less than 400, but um, when you get down into the entry level housing numbers in urban areas, you're typically seeing 12, 13, 14, 15% cap rates,
Oh,
even on
wow.
single family housing.
That's interesting. I spoke to a while back a firm that was doing development of sort of public housing, working with municipalities to refurbish public housing and provide better resources on site. And one of the remarkable results of that was that they saw a reduction in crime in the areas of which people who were investing in the real estate and actually providing quality homes at a reasonable price with good services actually found that people took care of their spaces because they cared and they were getting something for it and there was value there. Do you see similar trends when you think about kind of where you're investing, say in Baltimore, where if you go in as an investor and actually take care of the property and make sure your tenants are living comfortably and that the heat is working and that there's no rodents or anything, that all of a sudden, like the areas around it, other investors come in and crime rates go down? Or are you seeing similar trends like that on a like more microscopic level?
Yeah, I think so. I think if you provide a great environment for people to live, whether it's to live or to work, I think generally people react to that. So if you're, a lot of these urban areas like Philly, Baltimore, Washington, D.C., especially in the last 40 years, you can go into neighborhoods where you've got 10, 15% of the homes are boarded up. And, it's been my philosophy that when you go into an urban area where you have that, you have to come in and buy all the homes that are boarded up and renovate all of them on your block or in your immediate neighborhood so that you can really change the culture, change the mindset, change. People, I believe, are products of their environment. I'm a firm believer that if you go into a community and you get rid of the board ups and you take pride in the environment, that people will around you will rally around that idea.
Yeah, I think actually investors love that too. It's one of those things where, we talk about it all the time, this whole idea of passion and impact investing. And I
Yeah.
think people like to invest in a way where they know they're making a positive difference in their community or in society as a whole. And we talked about this before we went live, but I used to do pageants and it sounds very cliche pageantry, like I want to make the world a better place. But like realistically, I think we all feel that way.
Yeah.
And the opportunity to invest in a way and to support investments where you can get a good return for your investment, but also have a positive impact on a community is one that's really appealing to investors for sure.
Yeah, absolutely. I've done a lot of teaching for the last 30 years, volunteering teaching. I've been on the board of 4 schools, high schools. I've gone into a lot of inner city schools and taught 10th, 11th, 12th grade finance, personal finance. And when you can impact people's lives and give them a different perspective, I use the word awareness a lot. If people grow up in a crappy neighborhood with board ups and drugs and just that's all they know, If you can change their environment, you can change their awareness, which has a big impact.
I think kind of a great example of what happens when people actually take the time to do exactly what you're talking about is, say, like a city like Detroit, which is kind of having a renaissance
Yeah,
now, where if you went back even 10 years ago, Detroit was just all boarded up and dangerous and nobody wanted to be there. And then people took the time and made the investment and block by block bought up the houses, refurbished them, put them back out to the community at reasonable rents. Everybody wins in those cases. And now Detroit is transforming itself into a completely different type of city.
yeah. Well, you can thank Dan Gilbert, Rocket Mortgage, for his leading the way there.
Yeah, that's amazing. You said you teach courses all the time. What are some of the topics that you like to focus on in your courses with potential real estate investors?
Yeah, and before we hang up from this interview here, I'll plug my two books and a handful of my courses. So I like to teach private mortgage lending, but my main thing I like to teach, I have a book called From Worry to Wealth. A lot of people, I tell a story. I have 4 children. My youngest is a emergency room nurse, and when my 18-year-old daughter says, "Hey, Dad, I want to be a nurse," what do? I say, well, it's real simple. Go get a 4-year nursing degree and become a nurse.
Mm-hmm.
But what if my 18-year-old daughter said, "Hey, Dad, I want to be a nurse, but I also want to be wealthy. I want to create wealth. What do I do? Where do I go?" And for me, as somebody that at age 18 went to work for a wealthy individual and then became surrounded by wealthy individuals. And what I didn't tell you is my dad grew up in an orphanage. My mom grew up very poor. I grew up in a very, I guess, poor-minded environment. I went to public school. I grew up where there wasn't a lot of money, and the mindset of being broke existed. So I teach awareness that people that use real estate and people that leverage capital,
Mm-hmm.
especially other people's capital, there is a formula that exists. And I don't teach anything so profound. What I do is just organize a process for people that say, well, if I wanted to become wealthy and I wanted to understand what it is that I need to do, what would that process look like? And so all I've done is written courses and books about giving people tools to answer the question of process.
Right. Well, that's really interesting. I have a similar background. I grew up in Worcester, Massachusetts, which is a very blue collar, central
Yeah.
Massachusetts kind of town. It's and my dad was a cop, my mom was an inner city school teacher, and we didn't have a lot of money. And that broke mindset is one that's really hard to break. Uh,
Yeah.
Even when you have money, you are always anxious about not having money because you know what that feels like, and sometimes those things can actually influence your decision. So when you think about it, how were you able to kind of break out of that broke mindset?
It's very simple. The reason I say August 21st, 1983 was the enlightening day. That was the day of enlightenment.
Mm-hmm.
And the reason I say that is that I was taught up to the age 18, up to that day, how to think about money.
Mm-hmm.
When you're around wealthy individuals who are self-made,
Right.
they think differently and they teach you differently, and they explain how to approach something differently. And I call that awareness. And people that grow up in an environment that is less privileged than others, they may not be exposed to the awareness. And I don't want to get on my soapbox, but often we're influenced by our parents,
Mm-hmm.
right?
Yeah.
That's our first influence. Then we're influenced by our teachers, and we're influenced by our friends, and then our employers. And often, most of those people that are influencing us, they're all broke. So if we ask the question of how to become financially wealthy, and this is only about monetary wealth,
Mm-hmm.
this, we have many different selves, but from a financial self perspective, having a broke person teach us to be financially self-minded is very difficult. And it's not the person teaching you's fault. If you were trying to get physically fit and you weighed 500 pounds and you wanted to weigh 200 pounds, you probably go to somebody who's been fat at one point and then became skinny. I mean, that's who you would want guiding you. Unfortunately, our society is made up of teachers that are broke, teaching other people how not to be broke, but they don't have the capacity to do it. So that's my 2 cents on that.
Oh, I think that's very, very valid. I think that, you know, to your earlier point, that's why having folks like yourself and myself and my team, we do a lot of financial literacy courses, and we go into the schools as well. So we fully support that. And I believe that having some foundation in that and understanding that mindset is not necessarily the only mindset, that broke mindset. But if you've never been exposed to anything else, you don't know, and having them just be exposed can be powerful. So, well, we're coming up on time, and I have loved this conversation, but I want to give you a chance. Tell our listeners where they can find your courses and your books, and I'll include links in the show notes so that people can find it as well. But tell us a little bit about where people can find you and where people can find information about LYNK.
Yeah, hang on 1 second. 1 second. Let me grab.
Your
So I have
books.
these 2 books.
Yep.
This one is the one from Where to Wealth. They can get this on Amazon, or they can contact me and we'll get it to them for free.
Awesome.
And this is also on Amazon. This is for any investor. This is about becoming a private lender. And I wrote this book in 2015 for an explanation of why private lending is so powerful. Anybody that actually acts as the bank. LYNK Capital is LYNK, LYNK Capital. They can find us on the web. We're a great opportunity for investors looking for a secure, relatively safe, consistent investment return. We're an 11-year-old fund. We produced $1 billion worth of mortgages, had about 700 million repay, and have net yielded to our investors distributable cash of about a little over 10.2%. So that's dividend in investors' pocket. The last thing I'll say is that LYNK Capital dividends monthly. So we publish our financials and dividend to our investors monthly.
Awesome.
And of all the capital in our fund, the general partnership, myself and my partners that are the GPs, we have 21% of all the capital is ours. So we're invested side by side with all of our investors.
And just for compliance purposes, past performance is no guarantee of future results.
Yeah.
Make sure we get this through compliance, you know?
Yeah.
But that's very compelling. If you're an advisor and you're interested in learning more about LYNK, feel free to either contact Ben or myself. As I mentioned, LYNK is one of our partners on our platform, and we're happy to provide you with our due diligence and any of the additional information that we have put together about LYNK to help you as a fiduciary make these decisions. I want to thank Ben for being on the show today. I hope you like what you heard. If you did, remember to like and subscribe to our podcast. We really appreciate the support. And until next time, thanks for listening.
Thanks for having me.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Banrion Capital Management's platform. As such, Banrion may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guaranteed by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Banrion Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Banrion Capital trademarks mentioned are owned by Banrion Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.